GETCRACK. Wake up, motherfucker.
Leisman joins us here at Post 9 with a very special guest, Steve.
Hey, Carl, thank you. Yes, we are joined, as we often are, on the first Friday after the Fed meeting by Chicago Fed President Austin Goolsbee. Austin, thanks for joining us this morning.
Yeah, great to see you again, Steve.
And it just so happens, I guess this happens around December every now and then, that we have your favorite inflation gauge out this morning. It surprised the market a little bit to the downside. What's your takeaway, Austin?
Well, it's coming into the Christmas season, and it's nice to get a number that's better than expected. And I've been feeling that we're still on path to get to 2%, and at least for this new month, you don't want to make too much out of any one month, but I'm hopeful that this suggests that the couple of months of firming were more of a bump than a change in path.
Yeah, I asked the Fed chairman about this earlier this week in D.C., whether or not he was looking through it. You had maybe some hurricane effects in there, some other things. Were you among the committee members, Austin, who raised his or her outlook for inflation next year?
For next year, as you know, the dot plots are anonymous, but I have been feeling like there's a little more uncertainty, there's a little more noise, and so I raised a bit what do you want to call it, the shallowness. I made the rate path a little more shallow in 2025, but I've been saying that the overall thread is that inflation is way down. I believe we're on path to 2%, and over the next 12 to 18 months, rates can still go down a fair amount. And whether that happens 3 months earlier or 3 months later, I don't think is the most material thing. The thing that's material is we've gotten inflation down. We need to keep making some progress. We've gotten unemployment to a kind of a stable, full employment basis. We want to keep that stabilized. And the way to do that is to have the rates come down to something like neutral.
The chairman on Wednesday, Austin, said the following things, not together, but separately. He said, the Fed is significantly less restrictive than it had been, but is still meaningfully restrictive. Where do you come in on both of those sides? Where do you put us between being still restrictive? Okay, give us an idea.
I agree with both of those.
You think we're still meaningfully restrictive, putting downward pressure on inflation, and yet we're significantly less restrictive than we were, which means you sort of still think we're far from the neutral rate.
Yeah, all three of those. I don't think those are contradictory in any way. We had raised rates 500 basis points in a year. If you looked at just the real federal funds rate, it was the highest in decades. We're now down 100. We've cut 100 basis points, and so we're significantly less restrictive than we were. But if you just take as an approximation, where is the longer run neutral? Something like the median of what comes out of the dot plots on the committee, they think that the ultimate rate is around 3% with inflation of 2%, a real rate of 1%. We're still above that, so I still think it's meaningfully restrictive, and that's why I say over the next 12 to 18 months, if conditions keep on the way that they have over the last 18 months, I think rates come down a fair bit more.
Did Goolsbee quell fears of a rate hike next year? Because that was sort of entering the conversation. Torsten Slok over at Apollo mentioned that in a research report on Wednesday. But the data today, plus Goolsbee's comments, does that sort of take that off the table in your view?
For a little while, right? Until we get data that, right, exactly. I mean, so when I looked early this morning, the handles were maybe down 50 or so. And then after that PCE number came in, cooler, that was down about 24. And I don't know what the rest of it was as the day went on. Maybe it was those interviews. That could definitely be it because those were very bullish. But I think also some progress on the debt ceiling, that helped as well. And as well as the magnitude of yesterday, just kind of that sell-off was getting a little bit sloppy. So I feel a little bit better. It's nice to see that CPE number come in, or PCE number come in a little bit better, but I still think the trend is toward inflation and not a lot of cuts.
Right.
Yeah, I look, if the numbers bear out what the market really how they reacted to the PCE. You went from you basically rallied almost 260 basis points from 9:50 a.m. until the markets then peaked up, and then weakened just small off to the end of the day. But that translated into a major reversal over where we saw futures. So you looked at your screens in the morning before the markets opened, and you said, "Wow, this is kind of sloppy," and we're probably going to go into the weekend, and people are now reassessing their view of the Fed. But Karen, I think you're right. I mean, sloppy in terms of how yesterday traded or how the couple days have traded really since those Powell comments. I think that has as much to do with anything. I think markets are jittery. You look at the 5-day on the S&P, it's we're down 3%. I mean, it's been, even with this move today, it's been a rough period after such an extraordinary period for equities where the assumption was that inflation was your friend. We had a number of other prints going into the Fed meeting that had you believe that while inflation isn't out of the picture and disinflation is certainly a thing of yesterday, that the Fed is not going to be hiking. Having said that, that is the biggest risk for 2025 at this point. And it's not that the Fed will hike, it's that the perception of the Fed will change.
Yeah, I agree with that. I think the important thing is they're not going to be hiking. So whether they're cutting by twice or 4 times, not really the issue. The issue is, do they hike? But Powell, the day of the meeting, said that rates are meaningfully restrictive.
Right.
So he agrees with Goolsbee. He agrees with Williams. I think that, and he also doesn't want unemployment to tick up. So you do have the Powell put. Like, that's the way I saw it. I thought the markets totally overreacted to the commentary. I get it. He was a lot more hawkish than the market wanted him to be. I don't think the narrative has changed. Economy does worse, he's there. He'll cut more aggressively. And he's got plenty of tools or plenty of time and plenty of basis points to actually cut. I think the market got it wrong, but the market always overreacts.
I mean, there is still the sort of the conundrum, the squaring the circle that needs to be done between raising your inflation forecast and taking down the number of rate cuts. And that's still, even with the Goolsbee comments, Mike, that puzzle still remains.
Yeah, I think that's definitely true. I think what Karen was probably also referring to is that, a lot of the secular pressures that are inflationary, it's not like those things are just simply going to go away. We are at relatively full employment. So, of course, labor costs are something that we still obviously have to keep an eye on. I mean, to me, though, I think the important thing just in terms of what Tim was saying, which is that the market is clearly jittery, that bad news was really greeted with a very severe knee-jerk reaction. I mean, dropping 300 basis points in the S&P over the course of 2 hours sort of speaks to the fact that people might be a little concerned about the valuations. One other point I would add, and I don't think that's as true this week, but going into next week, and that is that we are, going to have a little bit less liquidity. I mean, there are going to be people who are not looking at their screens for all of next week. And, that can also create a little bit more of that kind of jump risk that we saw in prices this week.
Yeah, the liquidity get drained away, and also there's the seasonality. Seasonality typically happens in the second half of December, and here we are entering the Santa Claus rally period.
Oh, ho, ho, ho. And I do think it's been quite joyous to this point. And if you look at where markets really haven't had a chance to test the 50, that's what the S&P did. Hasn't tested the 50 really going all the way back to September. And I remember that since that last September Fed meeting where, yes, rates kind of then started rising, but markets also rose. And if you look at the NASDAQ was up almost 14% from that Fed SEP 17 meeting into this last Fed meeting. So I think a lot of this is just a function of where we've come from. It's been a really joyous holiday period, and again, since Thanksgiving. And the economic data, let's not forget, forget inflation. The data around retail sales, the data around the labor market, even there are people, we've had them come on our show talk about, they even think that the ISM manufacturing is doing a bottoming thing after a couple of years of what we know has been recessionary manufacturing activity. So the economy's in really solid shape right now. The market performed like that. So, yeah, I mean, it's kind of, to me, nice to see the reactions to the Fed almost like they used to be. In other words, where you didn't know what the Fed was thinking. Remember when the Fed was more opaque and less transparent? And it really felt like those were days where you truly got the cha-cha-cha.
More clarity with no clarity.
Yeah.
Hey, what's up? It is December 20th, 2024. options expiration day, triple witching, and you got the PCE all there. Okay, so I just wanted to give a quick update from my last discussion. I had a long discussion on Wednesday during that Powell thing. I didn't play none of that Powell stuff. I didn't care about any of that crap. You just look at the chart. You see that red candle just drop before he started talking, right? You had the dot plot. The dot plot was essentially saying we are only going to do 2 rate cuts next year. The market wanted 4. It didn't like that. First drop. Then he started blah, blah, blah. The market did not like anything he said because I could just sum it up in one thing. Powell doesn't know what's going to happen next year. That's essentially all he said. So you saw that huge red candle going all the way back down to probably election day's S&P 500 level. We hit there. Now you go today, this morning. Pre-market, we were down 1% on the NASDAQ, I believe, probably over 1% on the S&P, maybe at one point. Bitcoin was down maybe 3-4% in pre-market. Now, I waited for that PCE number to come out, and I said, this either will make this thing bleed so bad it'll spill into Monday, or it'll just bounce crazy. Boom. That usually PCE numbers are not supposed to be a surprise. PCE is calculated using the PPI, the Price Producer Index, and the CPI, the Consumer Price Index, okay? So both of those numbers give you the PCE, Personal Consumption Expenditure. Okay, I'm not going to get into what those mean. All that you need to know is that the PCE is what the Fed cares about, that number. And usually, when you have the 2 other numbers, there's no really any guesswork. Very rare would it surprise. This was a big surprise. That means it's telling you that inflation is under control. Now, in the speech, Powell was essentially saying inflation looks sticky. Now, what's one of the reasons it's sticky? Well, housing. Housing is a large chunk of the inflation that still has to be wound down. And interest rates are not a good way of doing that, at least in the first world countries. They do a fine job in third world countries, but interest rates, controlling the interest rates, the loans and all that does not work very well in first world countries, let alone the U.S., because the U.S. is very unique in that we have long 30-year mortgages. People rarely sell if they don't need to, okay? It works better in a place like Canada. Canada usually have 5-year mortgages. So when they raise their interest rates, the effects ripple through the economy much quicker. So, yeah, we have an interesting situation. Rents are not going down. I think there was some recent research showing a lot of this where rents have very little control. So I'm just not even talking about housing prices now. I'm talking about rents. So the rental market itself has very little control from the in interest rates that the Fed does. So this is a big concern, I think. This is what the Fed realizes now. And that's only one piece of the puzzle. I am going to assume that Powell said what he said because the Trump cabinet has been pretty much selected. I think the Fed, they have all these computerized models. They know based on those cabinet picks, they can try to guess, try to predict in some fashion the fiscal policy going forward into next year. Now, not only that, we also have the fact that Trump will start using tariffs, right, as a negotiating tactic. So this will be unpredictable as to how the markets will perceive things, because other countries will, try to tit for tat, and that'll screw up how the dollar will react. Now, if we have a very strong dollar, tariffs probably will not have much of an effect, because if another country retaliates, the currency of the US dollar will kind of buffer any sort of increase in prices due to tariffs, because the dollar is quite strong. So the exchange rate, our stronger dollar can acquire goods from other countries or services at a protected level because we have a dollar that can exchange for their cheaper money to pay for their goods. Now, the problem is also China. China is trying to do stimulus right now. It has been in a deflationary mode for quite a while. It's very desperate to fix their economy just to reflate their bubble, and also because they know Trump's coming back. So all these things probably combined increases the Fed's fear of inflation next year. And this is not a good thing, I think, for the markets overall. So we're fine now. You know, you buy that dip, that's okay. But starting January, maybe late January, we'll see what the Bank of Japan says, because the Bank of Japan talked right after Powell, the night of, and they basically said, okay, we're not going to say anything. We don't know what's going to happen either. So, you know, Powell talked, and then they listened to whatever he said, and then they just massaged whatever they wanted to say. And essentially, they don't know either. So this is not good. Not really good, I think. And you know what happened in August and July. The US dollar and yen currency affects the liquidity. So when that trade, the carry trade, comes back to affect us again, and it might be very soon, maybe end of January when the Fed meets and then the Bank of Japan meets, I would watch out for that. And plus, a lot of people made a lot of money these past 2 years. If there's any sniff, any smell of an issue, I don't think they would hesitate to sell. I mean, look at Palantir. Look at my Palantir. Look at my Axon. Look at anybody's portfolio. Anybody with a lot of large cap companies in tech should be very wealthy right now, right? These past 2 years. Taxes as a reason not to sell won't be enough if they feel like there's any trouble coming. So uncertainty is a bad thing. The yield staying high is a bad thing because, like I told you guys before, one of the things I expected was that if yields kept going down in a meaningful way, people would look at the rates from bonds and say, hey, I got a CD or I got a T-bill and they were 6% a year ago, right? 5 to 6% a year ago. Now they're 4 to 5. And then next year, if it says 3 to 4, people probably aren't going to be that interested in buying a bond. Even though a bond is safe money, people are greedy. And you could see it to like 2 days ago. People were very greedy after Trump got elected. And when they got too greedy, they got slapped down real hard, right? It was really easy to pull that market down when people are overcrowded in certain stocks. And certain stocks meaning the Magnificent Seven. So these are the things you got to look at. Okay, so I'm going to show you the screen, right? We're going to look over things here. So the damage done right here on Wednesday is pretty significant. All right, because now we're below some moving averages here. This means it's not going to be easy to recover, okay? At least for the S&P. It looks pretty bad. Now, you see the last time we did something like this, like October, like essentially Halloween, just before elections, and pop. See, that's an easy thing. People were just selling off into the elections. They didn't want to risk anything. But once Trump won, okay, recovered. Now, same thing again, right? Uncertainty. We don't know what's going to happen next year. People will probably be like, oh, I made enough money. Pop. They'll sell right away. Of course, there's another reason why they would sell. This might be nothing. This might not be actual real selling. I'm going to go over Max Payne after I show you guys this, because you guys need to know about options expiration and Max Payne. And you'll understand why we closed at this near this level of 590, 593, 595. Yeah, we almost hit 597. Okay, 595 about here. We got as high as that. Okay. So for the most part, Yeah, you don't want this thing to happen again. This July thing into August. And this, yeah, this gives me pause because I was expecting something to happen in January at starting with something like this, but it's already happened. So that's a good thing, I suppose. I would guess that maybe by the next 2 weeks they were talking about like liquidity and all that because people are on vacation. So that's why I said I stopped trading around here, right? I said like this first week of December, there's not many trading days left. I'm not going to do anything. I'll sell a bunch of whatever I already have. Anything left over, I'll keep. Don't care. Not going to be aggressive. Do anything. And then you see this, and most people would be like, well, it's opportunity to buy. And generally, it would be true. Yes, I think that means we have another move up. But I would caution you. So this thing might go up to maybe halfway of this candle here, close to probably the last high in November. Right? Maybe almost 600 on the S&P. And from then on, it'll just drop, keep fading back down. And the reason why I say that is because the small caps, this was very worrisome for me. So for most of December, I never really strongly recommended anything I was showing you guys, except for a quick trade, you know? And now, yeah. Seems like everything I see now may just be trades. Like, look at Sound, SOUN, right? Bounced, like it went down. I mean, it didn't even get hurt that much on Wednesday. It was up 20 something percent on Wednesday. Sold a bunch here, and it still was green on Wednesday. And then the next day, yeah, it tried to go up, went back down. Okay. But then today it goes back. It's like, okay. Okay, there's a lot of stocks like this right now. That have this nice volatility that you can trade. But if I was going to tell you like there were small caps and growth stocks that looked like you could hold it for a month next year, I've changed my mind. I don't think that's going to happen. Okay? Yeah, 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 I still have some sound. Yeah, I know. It's crazy. I mean, that stock is insane. But if you look at anything else, most of the stuff, I'm not talking about, most of those stocks are like dead in the water now after that whole thing like look at Palantir. This is crazy, right? No, most people are not going to be owning stocks like AOI. Yeah, look at that. Right back to the top. So this is worrisome to me. I don't think this is sustainable because if the Fed was very accommodative, like here, NVTS, I was thinking of buying it around 3, right? Now it bounces up today. This was a good buy, right? I would think it's a good buy for next year. But am I going to hold it for a whole quarter next year, into next year? No, probably not. Probably the first week of January. If this thing goes back to 4 or something, I'm just dumping it. Like, I'm not convinced about holding anything more than a week or 2 in January at this point. Because what you saw today was like a warning shot. That's a warning shot. It's telling you guys that you are greedy. You are over concentrated. The only reason it would drop like this so quickly is that, yeah, you don't have any confidence. The market has no confidence in holding anything next year. So here, I'll show you, right? So on Wednesday, I played Samantha Leduc's video, and what was it? The Mag 7. Oh, we'll talk about the yield curve some other time. Yeah, I don't think I want to talk about that. Cloud model, blah, blah. Yeah, Mag 7. You see that? Okay, see that? So this is a weekly chart. So in December, what were the places where people were buying stocks? Well, if it wasn't small caps, so it wasn't IWM, nobody was buying that. Like, it was going down all throughout since the first week of the Thanksgiving. So yeah, all through so basically last week of November into December, and then Powell speaks, crash. This is what I don't like. This is similar to what happened here. in 2021 before the stock market just completely fell apart. Because here was when the Fed changed their tune, right? They were like, oh, crap, inflation is a problem. I'm going to start jacking up rates like crazy to catch up. Okay, this is not, exactly the same, right? We're not raising rates again, but the fear is now back about inflation. And when everybody is running to just 7 stocks, Microsoft, Apple, Google, Amazon, Tesla, Nvidia, Meta, what else? Is Netflix even in there? No, Netflix is not in there. Amazon, yeah, okay. I talked to Amazon. Okay, let me copy paste this for you guys so you guys can chart this on your own. Yeah, I mean, yeah, HB, yeah, NVT. I mean, I should have gotten a Qubit. I'm like, look at this stock. I'm like, I'm never getting to buy this thing. I just keep talking about it, but I'm never doing this crap. Like, look at this thing. I think it was up another 22% after being down 40% yesterday. I'm like, this is insanity, right? And then Tropes was like, oh, you look at RGTI. Yeah, okay, see? Look at all this junk. Yeah, these are perfect for day trading. I don't know if I would swing trade it. I mean, you can, but since Powell was like said all that stuff, nah, bro, nah, nope. I don't think, because I think Rocket Labs, all these space stocks, they're ready to run. If Powell said a different script 2 days ago, I would have been like, yeah, this thing is ready to fly even higher, like way crazy, probably 200, 300% or something. But nope. We got the wrong script, buddy. Got the wrong script. So anyway, so this one I put in the chat, so you can plot it yourself on TradingView. You can copy paste that. You can just use that. If you have TradingView, you'll have to modify it if you're in some other one. You have to remove the BATS, BATS, a colon on there, and then figure out if you can put it in your charting program. So yeah, pretty good. But anyway, like I was trying to say, is that you have this nice run up here, right? And this is just before the crash. And then you have this next nice run up. So every time the Mag 7 has this parabolic thing, I'm just like, aha, we're ready. We have a setup, and you guys just had a little taste of how bad things could get. Just a little flavor, not even bad yet. So all you have to have is the Bank of Japan and Powell to say anything else that will make it worse. Like the dollar starts spiking, the yield starts spiking, the yen starts going crashing. If any of those things happen, boom, this thing would just rug pull all the way down. And guess what? If you just rug pull 7 stocks, and these 7 stocks basically is 33% of the S&P 500, you just rug pull 7 stocks right now. That's enough to just rug pull the whole market. You're done. The liquidity is gone. Bye-bye. So we're not there yet, but I'm just warning you. The conditions are there. The conditions are the same. So this thing can keep peaking around maybe 2 more weeks into January, right? So 2 weeks of January. Maybe you see some funny stuff happen in the 3rd week, because that's when earnings season starts up again. We start with TSMC from Taiwan. They'll report. They'll be the first one. And then you'll start hearing some other ones. And then all of a sudden, Powell starts talking again. Apple reports, Google reports, Tesla reports, and then who knows? That may be the start of it. That may be the start of bad things happening. So I would say maybe the first half of 2025 is going to go down. And then when you get into the summer, it'll be chop, chop, chop. And then only towards the end, it'll come back up. But essentially, the whole market is flat. So we'll start at a certain price level at just after New Year's, January 2nd. And then towards the end to the next year, it'll just be right back to where it was. So we're just going sideways. So essentially, next year is going to be a trader's market. Anybody that's an investor will not be happy. So if you're not trading next year, If you didn't learn anything I was teaching you guys in October until now, you guys are just going to have to suck it up and be like, man, my 401k is going nowhere. That's probably what's going to happen. Yeah, that's what I'm thinking. And then in 2026 is when the real fun starts, where we start going down. Because I think if Jerome Powell keeps rates very tight, like he is doing, keeping the rates high too long, he might break something, and we'll just end up with a recession anyway. So that's your choice, right? You fight inflation, or you fight the economy. Because he wants 2%. What if we're at like 2.8% for a while? Not good enough, right? 2.8% inflation. If it's not good enough, see ya. So tropes, if you're not using TradingView, yeah, you gotta, because BATS is just it's just where they get the quote from. That's all it is. The BATS colon. What you want to do is you take that equation. You can just put in Excel, you know. You just put, all you gotta do is figure out where you grab the. Oh, you're using TradingView, then just copy paste directly in there. You just go here. You see this? You can just put equations in here. You just put a whole equation in there. TradingView is very convenient on that. I'm not sure about Thinkorswim or the other guys. Because here you can use power, multiply, plus, minus, divide. I mean, that's the only reason I use TradingView, honestly, because they're very flexible. It's very programmer friendly. Like, look at this. They have objects. Like, I can just like remove or replace or do and you have the scripting here that, you know, the Pine editor here. I can just modify indicators or make my own, like here, see coding. So it's very programmer friendly, computer geek friendly, I guess. But, you know, this is only a preference, right? Okay, yeah. It says invalid symbol. Yeah, no clue then. No clue. Because here it says NASDAQ. Here, try this version. Here, this one has NASDAQ instead of BATS. See if that one works for you. You see that one? Yeah, you got to figure it out. Because here I just type manually. I don't do a copy-paste thing. So you see this? You just do Apple times 1. Like, you figure it out, right? You see that? It's just an equation. So yeah, you can type it manually by yourself without the BATS or the NASDAQ and see if that works. All right. Yeah. Yeah, yeah, so the problem is you shouldn't be having that NASDAQ or BATS in there, but because, like, you see that when I open it up, it pops out with the NASDAQ automatically or the BATS. Like, I don't know. So I can't get this without that crap they stuck in there. Because when you type it in yourself, like here, you're not going to type in BATS or NASDAQ. You're typing in like Tesla plus this, and then you times 10, you know, whatever, right? See? All right, you get it? Yeah. Okay, that's enough of that. What else? Bitcoin. Yeah. I am thinking, you know, I should have shorted the crap out of MSTR on Monday. Fuck. I didn't know it was gonna drop this much. The whole week. I didn't know it was gonna be a whole week. I would have made like 50, 60, 70% or something. Shoot. Man, I was really lazy. I said like, oh man, I bought MSTR here and here, right? And then when it jumped up on Monday, and just as it was starting to fall, I was like, oh shit, get out. And it was near the end of the day too. And if I was like, if it started happening beginning of the day, I might have considered shorting it here. But I was like, I don't know what. Yeah, I'm out. I don't care. Maybe I'll revisit to like the Tuesday. And then Tuesday, it just jumped up real quick and then started going straight down. I was like, is it good to short down here? Like, you know, that's the problem, right? When you're shorting, you rather short like above like the resistances, you know, this box here. I would rather short here. But once it like Tuesday, it didn't even like get back up. It just went right back down immediately. And I was like, it seems too risky to short down here in case Bitcoin might pop up. Shoot, man. Yeah, if I knew this whole thing was gonna happen, crap, that was like, oh my God, that would have been a great short. Oh man, beautiful. And then I would have just got long here like I did on Thursday, because Thursday when I saw this whole move here. So here's a tip, right? Like this is right before Jerome Powell speaks. You see this? You see how weak it is on Wednesday before he was speaking? Like you look at the moving averages here on this 13-minute chart, and I can use the 65 too, so for you to see. So 65 is this 1 hour basically. But yeah, you already see the weakness building here. But yeah, when you go down to 13 or 10-minute, whatever you want to use, yeah, you see like the way it's doing it. It's like it can't even like do anything. And then right away, when Jerome Powell hasn't even talked yet, the Fed just released the press release. When it did this, and then it just continued, you should have just went like short the shit out of it. Because even if you missed that, then there you had a second opportunity on Thursday. It popped up here and it just went straight down. And the thing is, Bitcoin's chart made it a lot more clear because you had the overnight. You can see what happened overnight. Overnight, after Jerome Powell talked, it went back up here. But here, I use 40-minute for my Bitcoin. Here, this is clear. Yeah, 40-minute I use for Bitcoin. You see the trend starts building after Tuesday's move. So it just failed to hold Monday, and then Tuesday, Wednesday, it's just weaker and weaker, and then it just breaks through 103. This level here is really important after Powell started talking. So the next time it moved up overnight, you would have been like, okay. And then right when the market opened, and that's why I was telling people, hey, Bitcoin just follows the market now, because all the ETFs of Bitcoin combined own more Bitcoin than theoretical ownership by Satoshi Nakamura, whoever the heck he is. And so not only you're influenced by the futures market, now you're influenced by the regular market just because of those ETFs. And those ETFs recently got options on them. So the SEC approved options being used on those ETFs. So not only you have futures and options of Bitcoin, but you have spot and futures ETF with their own options on them. So now you have a derivative of a derivative of a derivative of a derivative. And then I can't even explain all the issues with that, but mathematically, like anything could just cause issues, right? And so this is what you're seeing. Like right when the market opens, like boom, down. So overnight, so like it's a calm, right? Look at the volume, very little. And then all of a sudden, like, oh, market opens, the US market, apparently that matters to Bitcoin, and boom. It's just like, fuck. This is easy. This is clear short right here. You have a pinch right here between the 18 and the 40. So yeah, and you do the opposite when you want to go long. But when you see this and then you look at the MACD, like look at it. It's been weak since Wednesday. And then every time it tries to get close to zero, the MACD, close to zero, and you see this, and then you see this failure, it's like shorting time. And you could have shorted all the way since here, technically, and just kept holding all the way down. Yeah. If you were that ballsy and said like, I don't know what Powell's going to say, but if I start shorting here, at least I have a lot of wiggle room to not care. I'll just keep holding and seeing if it comes back up here, fine, I'll close my position, right? But if you wanted to, yeah, that whole first week, that whole week I should have just been like, oh, that's the easiest trade to do that whole time. Didn't need to worry about anything. I didn't care about Powell or anything like that, because if I entered here, I was way above anything, because this thing was a distribution, right? This rectangle. And I think right now, Bitcoin, if it goes back up, it'll have a lot of trouble at 103. If it gets lucky into New Year's and actually comes back up to this area again, I think that's it. I think that's the end, okay? So that might be all we're going to get Might be all we're going to get for Bitcoin until March. And then when you see March, April, and May, we might get another cycle there starting from that point. Okay. All right. Let me play another video. I think I have a couple more videos, and you'll see about the VIX. I think that's a good thing to talk about. Oh, Tom Lee. I'll do Tom Lee first, and then I'll get back to the Max Payne. Okay. Then you'll understand what really happened, because every time you're gonna have triple witching, you should know this, especially when you have like a big one. Like this week's options expiration was huge, the largest in history. So the derivatives market pretty much controls everything else when that happens.
Guest thinks this is a great buying opportunity and the Fed remains supportive. Our other thinks the Fed will be on pause for the time being and could even hike again if inflation reignites. Joining us for more is Tom Lee, Fundstrat Global Advisors Head of Research and a CNBC contributor, and Jeff Kilberg is founder and CEO of KKM Financial. He's a contributor as well. Tom, we'll start with you. I take it you think this is a buying opportunity.
This is another buying opportunity in our view. 2024 has proven to be a year where the market's been strong and it has eluded many opportunities for sustained weakness. I know yesterday's pullback was really painful, but to us, I think the fundamental supporting stocks are intact, and I think it's a good opportunity for investors here.
A good opportunity for investors. Jeff, I take it that you feel is differently putting it too strong?
Well, I don't disagree with Tom on the fundamental side of it, but I think if you look at where we're at with the interest rates, what's on the horizon from taxes, tariffs, and deficits, I really have to be considerate of what happened yesterday. It was the second largest move in the VIX we have seen. And historically speaking, Kelly, Tom is right. A month after that spike in the VIX, you see the S&P 500 higher. However, I don't think we can lean on history here due to the fact that we've seen stretched valuations in the top 10 names of the S&P 500. We've also seen just a straight line up. If you look in the last 2 years, back-to-back years of above 25%, we've become conditioned that the market's just going to continue to move higher, thanks by and large to the Fed dovishness and their $7 trillion balance sheet. So I'm looking, I know Tom wants to back up the truck here. I have the truck running, but I'm not ready to back it up yet. I want to see this more process, reset valuations. I think that's going to be the next couple months, possibly the first quarter, because we've become too conditioned, Kelly, to markets repricing in a day. I have to go back to my 30-year career and understand that we will see reset valuations more of a quarter or two, not just a day or two.
You know, Tom, this has been a bit of a slide for the Dow, to put it mildly. We had 10 down days in a row. You say you saw signs of capitulation yesterday, as it was a 90% down day.
I did, Tyler. You know, as context, the market has been bleeding lower. If you look at internals for the last 10 days, yesterday looks capitulatory because not only did we have a 90% down day, but the VIX, the spot VIX, exploded by 75%. There's only 4 times in history where it's risen 60% in a day. So yesterday was the 5th time in its 35-year history. Of those 4 times, the market recovered all of its losses within a week, 3 out of the 4 times. The 4th time it took a month. So I think what you had was people panicking to get out of what they thought was a momentum trade that's ending because we're so close to year end. But here's the interesting thing. The forward VIX futures curve barely moved. So it was almost as if people were seeking protection through the VIX yesterday.
What tells you, Jeff, that more valuation resetting is to come?
I think due to the fact that we only had 1 down day, Ty, typically when you see prices reset or revalue, you have consecutive down days. And those consecutive down days bring along margin calls. And you saw Interactive Brokers head talk about his concern of margin being used on the Mag 7. So when I look at a day like today where you're seeing passive indexes buoy the overall 3 major indices, NVIDIA, Facebook, these names are coming back because you're seeing people deploy cash in a passive index. So I do get concerned about that short-term volatility, but I'm going to embrace this volatility over the next month or two because I don't think history is going to line up. This is not going to be the same way. We've seen a straight up move ever since last November, and especially since November 5th after the election results. So I do have concerns short term, but I am cautiously optimistic at 2025. But there's going to be more volatility. This was like a depth charge that went underneath the water. There will be ripple effects.
Tom, let's talk about the small caps for a minute, because they have these kind of moments where they look really promising, they go on a tear, and then it just stalls out. And a lot of investors are feeling frustrated and wonder if it's worth sticking around.
Yeah, I mean, I'd say investors are tired of having like the rug pull on small caps. Yesterday's an example. Unfortunately, when markets get nervous and they're risk off, and of course buyers disappear, stocks that aren't as liquid get hit harder. That's why the Russell not only has been sort of under pressure for a couple of weeks, but really got hit yesterday. But do we think anything has undermined what makes small caps attractive the next 5 years? It's still in place. I mean, they've underperformed the last 10 years by the second largest magnitude in the last 125 years, except for 1998. So not only are they derated, but now we have a roadmap of deregulation, possible mergers, at a time when financials, which is a huge weight in small caps, look more promising, and things like biotech, which is a huge weight, also look more promising with deal activity. So I actually think this is, again, another chance to buy a dip.
Okay, Trope said, isn't that custom index? So I don't remember exactly how I did it, but you have to pull out your spreadsheet. You essentially, what you have to do is, there's 500 stocks in the S&P, right? 500, the large cap index. I take that and I try to take out Google's contribution, Amazon's contribution, Apple's contribution out of that, but keep the weights there. So I had to, like, they won't tell you what the weights are. You have to like reverse engineer and figure out what the weights are of because that's proprietary information apparently for the S&P. Like, they don't want to tell people what it is, but you can derive it. If you just put down everything in a spreadsheet, you can figure out what the weights are basically for each of those stocks. So that's what those multipliers mean. So I try to keep the weighting, but rip out the stock out of the index. So I made my own S&P 7 index. So let's say I have an ETF, and I just try to just do Apple, Amazon, Google, Tesla, blah, 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 and just have those 7. You see how it performs, right? You see how they perform. That's essentially it. And I could just make my own ETF and sell it on Wall Street, and people could just buy it, and I would just make my own leverage ETF of that crap. I'll show the chart again. Yeah, if you just made your own like portfolio with just those 7 stocks, you just did way better than anything. Like here. So let's say I go back to just before COVID. And from COVID on, let's say I just make this new ETF called the S&P 7. You see that? I'm still up 185.18%, even with the whole down move in 2022. Like, I'm still up 185% from just before COVID's drop. Okay, and then you compare it with like S&P 500. S&P 500 is only up 83%. So you can see how much performance I would have if I had an S&P 7 portfolio instead of having just following the SPX. So it's very tough. Yeah, very tough just to, just beat the S&P 500 in general. But if you knew COVID was coming, right, that's number one. And then these tech stocks will get even more powerful from COVID. Plus, the fact that NVIDIA is going to be the leader in AI from 2023 to 2024 onward, and you pack them all together, then yeah, these were the stocks to be in. Of course, I could construct anything like this and outperform this too. I could just like put in Carvana. I could just add Carvana in here and rip out the weakest link. Maybe I don't know. Tesla kind of like went sideways a lot for most of this period here, so maybe I would replace that with Carvana, and then you would see like a really outperformance. Carvana was like 6,000%, right, from the end of 2022. So if I actively manage this thing, but yeah, that's all theoretical, right? I mean, that's 2020 hindsight. I'm not gonna be able to predict like, oh yeah, this thing is gonna outperform from this point on. This thing is underperformed. That's the challenge. You really can't tell that far ahead, but at least you can try to make it so that you can outperform in general, and that's always the goal. Yeah. But in any case, yes, you can do this yourself. You can make your own like indexes and whatever, all this type of stuff. Yeah. Okay. Next video. So this is going to be a companion video to that one you just heard, like about like buy the dip, because every time the VIX goes high, buy the dip. And what is the VIX? Well, the VIX is a measure of 30-day, pretty much a month, okay, out implied volatility. Okay, and then you're going to ask me, what the heck is implied volatility? Okay, in the options world, options have, certain characteristics. One of them is pricing in volatility. I think this is, I don't know which Greek it was. I think it was gamma. I don't know. I'm not an options guy, all right? But based on what people buy in terms of puts and calls, you have an index called VIX. And VIX will tell you if the market thinks, oh shit, something is wrong here. So usually when the VIX starts spiking, that means stocks are dropping. Not necessarily though. Sometimes the stocks can go crazy going up and the VIX will start going up with it. That's pretty rare, but that's how bear markets are. So if you look at the 2022 period, it was kind of like that, where you had a lot of things moving up and down very rapidly, and that's just volatility. So that's what the VIX is trying to measure.
VIX has been all over the place this week. What's the message here with it now down 20% today, under 20?
Yeah, the VIX is during a mid-cycle rally like we've had since the beginning of October 2022, a very important signal about where you can step in and buy a dip. And we got a very key buy signal on Wednesday with the VIX closing at 27.6. That's just over one standard deviation. Only happened 2 times since October 22, right at the beginning of this rally, and then again in August 5, 6, and 7 of this year. And in both times, the S&P was up 4 to 5% in the month after the VIX hit those levels. So we've gotten that buy signal again, and we're very bullish here.
That's what I was just thinking, when you were talking about the VIX spike, I was thinking back to, I think it was August 5th.
Okay, so you see this chart? This is the VIX, VIX, and usually what people talk about is when it hits some certain level and then it comes back down through it, you're just going to be like, okay, it's time to buy, right? That's really the best time to buy. There's other ways to measure too. I have other ways, but this is one that's popular. And usually when it gets above 20, there's an issue. But I mean, I don't know. Over the years, since the 80s, like what level represents a buy, it might change, So he's using standard deviation, if you heard that.
And we had all those concerns about Japan, and I think the VIX went to like 60 or whatever it was. And I mean, well, you're essentially telling me that whenever the VIX has a massive spike, that it's generally a buy.
It is. The only exception, and think back to 2022, we had several VIX spikes to 36, which is 2 standard deviations above the mean. Those weren't great buy signals because we were still in a bear market. The point is that when we're in a bull market, these VIX spikes are a real signal from the market saying fear is overblown and it's a good time to buy. And that's what we're seeing here.
Okay, so buy the dip. I mean, it's not like we don't have concerns to think about. Right? I mean, if the Fed's going to cut much less than we originally thought, and we're still not sure exactly how many times, just because they tell us, well, it's likely to be 2 next year, that doesn't really mean anything. That's our baseline to go off of. We have policy uncertainty and everything else. I mean, there are reasons to be a little cautious, no?
Oh, absolutely, absolutely. And look, Powell's press conference on Wednesday was kind of a disaster. We started with a comment that the rate cut on Wednesday was a close call, and we ended the press conference with his comments saying that he couldn't guarantee there were no rate hikes next year. And everything in the middle was just the same kind of mishmash of if this, then that. So there's a lot of rate uncertainty, you're right. But at the same time, we've got a good economy, a good labor market, and growing corporate earnings. And that's the recipe to keep this rally going. And that's why we're bullish.
Yeah. Where do you want to lean into then?
We really still like financials. They've had a great run this year, obviously, but they're still the second cheapest group in the S&P at 17 times forward earnings. You have tailwinds from lower than expected loan loss reserves because the economy will stay good, and the potential for deregulation. So the financials are still an area to definitely lean into. They've done the best this year, and they should have a strong 2025.
What about tech before I let you go?
Sure, tech is another area we still like. We do still like big tech as a group. We don't call out single names, but those 8 companies that dominate the top of the S&P should outperform next year as well. And that's another reason to be bullish. But it's not just tech, it's also financials. It's a much more broad-based rally than we had in 23.
Well, let me just ask you real quick then. I mean, maybe are you saying you're not allowed to name single names, or because these things sort of stop trading like a monolith? Your answer sort of suggests that you think as a group, they're going to go up. Can you just clarify that so I understand where we're coming from?
Yes, you've got it exactly right. It's
Okay.
if you want to play that space, then the Qs are a perfectly viable way to play. We think they outperform.
Okay, I got you. I just wanted to make sure we're on the level, that you weren't talking about these all going up to the same degree. I'll talk to you soon, Nick. Thank you.
Thank you.
Nick Colas.
Okay, I think that was a very good explanation, honestly. Out of all the ones I've seen about the VIX, I think I have to go look and find an old video with Tom Bowley and some other people from Stock Charts talking about the VIX too. Also, there's another ratio called the equity put to call ratio. Oh yeah, I gotta talk about these things. I don't know. Oh my God, that's more esoteric. I think you go deeper in the woods. There's also like they talk about deterioration. So I just show you guys like the small cap index, the IWM, but there's other ways too. There's the NYSE composite index, and then you also can look at their above 50% or 50-day moving average. What percent they're above? Yeah, some other ratios. Like you can have other ones that'll show you more clearly deterioration. So that's why I was always skeptical since Thanksgiving. It just felt like I don't know, why would I buy anything before Powell speaks and all that? Like, of course, Powell could have said nice things and the thing would have popped and everything would have been rosy, right? But he didn't. So now it just confirms my suspicions that it's not going to be easy 2025. So sorry, guys. I think for anybody that's an investor, you're not going to like it. If you're a trader, you'll love it because things will go up and down like crazy based on, and just look at how it's doing now, just based on one small piece of data, one little crumb of economic data, and then you just whoosh, you just move up all the way back to like nearly half of the loss of Wednesday. So Powell just essentially just said, yeah, just look at the data, guys. That's the only thing you'll need. Well, that means every small piece of data that's coming out next year, starting with unemployment payrolls data for December. So that's going to come out Friday, January 3rd. So that'll be the first one that we'll have next year. So who knows? We might get some crazy moves just on that Friday right away. So do not be complacent. Even if you're on vacation, you better like get your phone working. Like be prepared. if something goes down, we might just go right back down through all these things, moving averages, levels, and crash again. Friday, January 3rd. I don't know. Yeah. That's just how the market is right now. We are now very, very data dependent. Very data dependent. Okay. So I got another video for you guys. But before that, let's talk about Max Payne. I got to talk about Max Payne before you guys forget what I was talking about. Yeah, this one should be very educational. I think I've alluded to it a few times when I was talking about options expiration. Let's see here. Okay. So again, let's go over what happened in the morning. So, and this is Pacific time, okay? Pacific Standard. So this will be 8:30 Eastern. And you can go to tradingeconomics.com. Yeah, you should go to here and you can do it yourself. This is the United States calendar. You can go around the world and you can look at all the calendars of the world when they announce important economic things. And usually I would just look at the Bank of Japan, China, and us. Europe has some influence, but has a weakening effect most of the time. There's not much Europe can say at this rate. Okay. Oh yeah, I should say something before we continue after this into the video. Hopefully I'll remember it. But in any case, you got the PCE, core PCE. This is what the Fed looks for. All right. They want this number down to 2%. So right now, year over year, the PCE price index, the personal consumption expenditures or whatever, I think that's what it means. Let me see. Oh, they don't talk about the dang thing. Okay. They don't define. Yeah, personal consumption expenditures. Yeah, I was right. Okay. So this is at 2.4 year over year. Now, the most important thing is you're looking at the month over month, and they forecasted 0.3%, and the actual one was 0.1. So that's one of the reasons why we had a very sharp recovery in the morning. Now, you also look at the Michigan consumer sentiment. What the Fed really looks at is the inflation expectations. So, inflation, a lot of times, is due to how people feel. Okay. So, the Fed really wants to know, what do the consumers think about inflation? How do they feel the inflation is going? Are they feeling that it's coming down or not? So we're down to 3, so from 3.1. So that's a slight improvement. So that probably juiced it up a little bit more. And then you had Goolsbee from the Chicago Fed talking on CNBC, so that helps some more. But so far, yeah, we're stuck around 3. So people really feel inflation ain't ever really going to come down. So this is what they feel like. 5-year outlook. So this is what they feel like inflation will be 5 years out. So they still think it's around 3%. This is not what you want to see. Okay? This has to come down. I don't know if it ever really will come down at this point, unless we have a severe recession. Okay, so that's something you got to look at. This is what they care about. Core PCE and the Michigan Consumer Sentiment Survey with the 5-year inflation expectation. Those are the key ones that they'll look at. And then the other one is payrolls, right? Payrolls that we get at the beginning of the month. So January, when we get our payrolls number on the 3rd, we'll talk about December, the whole month of December's job payrolls report. You look at unemployment, things like that, and how many people are. And we might have a strike again, right? So the longshoremen might come back and strike again next month. That's also another thing that might be interesting that will happen. But anyway, here we go. Max Payne explained how it's calculated with examples. Okay, this is really important. So what is Max Payne? Max Payne, or the Max Payne price, is the strike price with the most open option contracts, puts and calls, and it is the price at which the stock would cause financial losses for the largest numbers of option holders at expiration. The term Max Payne stems from the maximum pain hypothesis, which states that most traders who buy and hold options contracts until expiration will lose money. So who are those people? these are the gamblers. So people that buy options, puts, and calls are usually the small guys, like the people on Robinhood or something, that just want to gamble because they can't afford any shares of stock, but they can definitely afford a contract or two, right? And gamble on stocks that way. So max pain, or the max pain price, is the strike price at the they already talked about that. Okay, so expires worthless. Yeah, we already understand. So what is understanding it? Let's look at this. So I can't go over options with you guys. You're gonna have to bear with me here while I read this definitions. According to the maximum pain hypothesis, the price of an underlying stock tends to gravitate towards its maximum pain strike price. So the price of the stock is going towards where these options, are located to cause as much pain for the people buying options. Okay, you kind of get that? So this is what you heard with when they say the tail wags the dog. Because you would think like the price of a stock is just people buying and selling the stock. That will determine the price. But we've entered the point where there's so many options out there for stocks, indices, ETFs, everything, where the options are the ones controlling the price. How does that happen? How do a derivative of a stock control the price? You would think, hey, come on. If I buy and sell something like a house, like I just agree to a real estate agent and their real estate agent, the buyer and seller, agree on a price. That's how it works. That's how stock markets should work too, right? Nah, man. That's not how it works. Not anymore, anyway. So we're not gonna get into the nitty gritty on why that ain't true anymore. But this is, me. I don't really understand options either. I don't want to understand. But the thing is, if you want to understand how price moves in the world right now in the stock market, you're gonna have to at least understand that options controls how the price moves, at least during options expiration triple witching week, which was last week. So all the crazy volatile moves, I said 2 weeks ago, I said, hey, watch out, something's going to happen. The big moves down and back up is all because of this. So when people go on CNBC and they say like, oh, it's because the Fed said that, it's Powell said this, it's because of that, it's because of this. No, I think you can simplify it in one word. It's just the options, man. The max pain. This is where it's coming from. So the maximum pain hypothesis, all right, states that option writers hedge their contracts. So what does that mean? What is the option writer? Who is the option writer? Well, this is what the market maker is. In the case of the market maker, the hedging is done to remain neutral in the stock. Consider the market maker's position. So the person selling options to all those gamblers on Robinhood, to anybody that wants to use options as insurance, the guy that's selling it is going to affect the stock market. How? The hedging is done to remain neutral in the stock. Consider the market maker's position if they must write an option contract without wanting a position in the stock. As the option expiration approaches, option writers will try to buy or sell shares of stock to drive the price towards a closing price that is profitable for them. Now you're getting it, right? So the person, like let's say a bunch of people go on Robinhood and buy a bunch of puts, then the market maker is going to have to hedge that. So if I'm writing all those puts to those guys buying the puts, I'm going to influence the price of the underlying stock because I'm going to have to buy, sell stock in a way to push the price towards a place where I feel comfortable selling those options. This is how they hedge. All right. So if they're selling calls and puts, they have to buy and sell shares. This is where the funky stuff actually happens. So those little guys gambling on puts and calls actually do affect the price of the stock, because the transmission of the action, it's just like me pressing pedals on the car, right? I'm not physically moving my car with my hands. There's a gasoline engine or an electric engine or whatever. I also have brake pads, all on my wheels. So I'm transmitting power from my foot to a car. And a car is exercising a lot more energy, right? And so the market makers are the engine of the market. So the put and call buyers are like the people pressing on the pedals, right? That's what they're doing. They're pressing the brake or they're pressing the gas. and that's how they're affecting the whole market. Yeah. Yes, they affect the direction they want it to go. Yes, that's right, tropes. This is right. And this way they don't need to pay out any of the premium. So they want to make money on that premium, right? They want to just make money on the premium on those options. They don't want you to win. So I place my bet. I get charged a fee. That fee is called a premium, right? So they want to collect their premium without actually paying you the winnings for picking the right price that it's going to end up in. Anyhow, so I'm going to show you the Max Payne chart. So this is so interesting because right there, you'll see right away. So there's this website called optionschart.io, and you can go over there and you can check it out yourself where the auction price is. Right there, here. Okay. Optionscharts.io, options, and you can look at for any ETF or any stock, I guess. I assume you can if they have most of it. So you see that? Look at the price we ended up in right here. So Max Payne for S&P 500 is 598. So on Monday we were up here, right, at 6, like what is it, 6 something, man. 608. Yeah, we were here, 608 up here, right? Something like that. So we were above the Max Payne, right? A little bit. And then on Wednesday we crashed down to what? 580 like by Thursday? Yeah, 586. Yeah. Yeah, so 586 down here. Right, there's somewhere here. So we went below the Max Payne. And then on today, right, let's see. Yeah, here. And then now today, where we close at? 592. So pretty close to 598, right? So we went up and down. so all the call guys probably got burnt on Wednesday, and they just closed their positions in complete agony. And then on Friday, all the put guys got the reverse action. They just got burnt because they went back up. So the casino won. The casino won. We just ended up right back where we were supposed to end up. And this is why the third week of every month is important. And especially the third week of the third month is even more important, because that's when the triple witching and all that other stuff happens. It's just like, whoa. So always pay attention to these weeks. If you can, just try to stay away. I don't know what can you do, really. So yeah, the thing is, tropes, yeah, that's the problem, because like it depends on what strike price, when you bought it, too. So if I buy an option way early ahead of time, it might be cheaper, depending also on the price that the stock is at. And the closer we get to the expiration date, then it gets more expensive, and then the volatility increases. And all, like, I don't know, man. And then you have these 0 day expiration like options. That's like completely insane. I have no idea. What's up, Chris Reed? Oh, he might be good. Man, Elon Musk is gonna do that. I think Elon Musk is gonna be president of Mars, man. President of Mars. All right. Any case, let me put in the the chat. Oh, I already put that in. What the heck? Come on, copy paste this. And the next thing I might want to talk about is the JPM hedge collar ETF. So this is the Max Payne thing because Investorpedia article. So yeah, there's this something called the JP Morgan Hedge Equity Index Fund or something. I don't know. This is more complicated, but people have theorized that this ETF is so huge right now. A lot of people, when they buy the S&P 500, you can just buy the S&P, right? SPY or the VOO, some kind of ETF. But this one's special. This one, it tracks the S&P 500, but they sell calls and puts to try to limit any losses when you go down. But it'll cap your gains, essentially. So this is like someone who buys the S&P 500 but also pays for the insurance. So people that are lazy, they just allow JP Morgan to do this for them. So instead of me just buying the SPY or something and selling calls and puts on that ETF myself and decide what insurance products to buy using options to protect myself, I let JP Morgan do it. And the way that JP Morgan does it is theorized to affect how the market runs because they do it every quarter, right? So every time we get to this option expiration week, they have to sell and dump some things and buy some things. So the options, they have to change. So every time it expires, they got to reshuffle where they want to put new options and call on there. So the puts and calls get changed out. And essentially, it affects where things are going. And so I had this blog. Man, I don't know if I want to read this. This might be so confusing to people at this point because I'm not a really good person to explain this. My knowledge of options is so weak. It's better you get John to maybe he can understand this stuff. But here, this is a Substack by this Vukovic. Okay, Oxford PhD, runs a hedge fund. This guy's pretty good at talking about this stuff, but it's, man, you see these plots? Every time I talk to some smart ass about options, like really some guy that really knows what they're talking about, they start pulling out these graphs. Like this 3D graph, I always see it all the time. So you have this axis is charm, this axis is that, this axis and gamma, blah blah blah, and you're just like, what the fuck are you? It's like if you really need to understand options, outside of the basic Robinhood level, like the basic Robinhood level guy is just gonna come in and be like, I want to be long on Apple, I just buy calls. I want to short Apple, I want to buy puts. And then if they're a little bit more sophisticated, they'll pull out this graph and it'll show them. Here, I'll pull out the graph again. I have this nice cheat sheet on options. Yeah, here's my cheat sheet on options here. I'll put the link in chat. Go here. Have fun with this. So this is the nice cheat sheet. I'll show you this. So if you're a little bit more sophisticated, you'll have this one. Okay, you'll have just cheat sheet on your room. You'll print it out, high resolution here, and you'll start doing all this crazy crap. So here you go. You got bull put spread, bear call spread, iron butterfly, iron condor, long call butterfly, blah 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 blah, dragonfly, this that straddle. Yeah, good luck. Yeah, you can. This is your cheat sheet for you, how you want to do this. So yeah, but anyway, if you're really sophisticated, you got these nice man, I forgot what they call these things. I think Bookmap probably has this stuff. Yeah, you can look at Bookmap and you just like these heat map essentially that shows you where everyone's concentrating their positions. And then you have the 3D plot where it shows you like, oh, okay, if things move on this way or that way, then I'll know where my options pricing will be. And it's just like, holy shit, dude. I don't got time for this, bro. I might as well just go back to engineering, man. Like, what is this? So yes. I think this is very fascinating. But in summary, here's what he came up with. So this was for last quarter into this quarter, okay? So this was written in October 5th, okay? Yeah. So that this was the beginning of the quarter, the fourth quarter. The new caller's upper value, the call that was sold, is 6,055. The long put is at 5,450. The short put at 4,600. So if the market keeps pushing up, expect it to get pinned once again around exactly this upper level by the end of the year. That's why the S&P to 6,000 target is quite realistic. Did you see that get pinned again? If the market continues to push up gradually over the next 2 months. And guess what? So what did the S&P 500 do before this week? Where did it get stuck at? 6,000, didn't it? So the S&P, the SPY was like 608. Yeah, so it was basically stuck at 6,000 for most of this month. So that's why after Thanksgiving, you're like, I'm done. I'm done trading. And this is one of the reasons why I said that. It's because like the easy money has been already made from the Trump election. So if you bought that dip just before Trump got elected on Halloween, all the way and sold into the end of Thanksgiving week, or maybe you held some positions into the first week of December, but basically at the index level, at the S&P 500 level, it wasn't going to go nowhere. It was done. And this is the reason why. So, JP Morgan, thank you, JP Morgan. Yeah, so yeah, it'll hurt your brain. Yeah, I don't know, my brain. Yeah, John could probably, I don't know, maybe young John probably would have loved this shit. I hate this, man. Oh man, and that's why a lot of quant houses, quant analyst places, hedge funds, they love hiring physicists, engineers, mathematicians, because those are the ones that can do this work for them. So even though you're in a field that's not related to this, you have a basic level of math from college that can let you understand this. You also probably, if you're in physics, applied math, and engineering, you probably dealt with software where you had to model, like if I did an airplane, right? I would have to model like the fluid dynamics of the wind and all that going through an airplane. All that stuff is probably the mathematics, and the concepts are quite similar to options market pricing. So either I learn how to make an airplane fly, or I help JP Morgan rip you eyes off, right? Every third week of the third month every year. So which one is it? I think you can make a lot more money doing this than making airplanes fly, honestly. And then making an airplane fly is way harder work than just like figuring out how to make options move up and down all over space and time, So okay, that's a side thing. This is a side thing, but you can see the rabbit hole here. This is just the tip of the iceberg, learning this stuff. And let me give you the Substack link, and you can go read it yourself, because this is just a teaser. It's very hard to find good information like this nowadays. Most people, if they know this stuff, they wouldn't even explain it to this level here. So just having a glimpse of this is very helpful, because at least you have kind of an understanding. I'm not going to take this stuff lightly every third week of the month. Yeah. Okay. Anything else? Oh, breath. I don't know if I want to talk about that yet. No, probably not. Maybe I'll save it for next time. That's a whole nother discussion, breath, and all. Like I kind of alluded to it today, talking about it, because we're going to get into like the end of this hour here, and I only have one video, and I think it's 30 minutes worth of video. But first, let's have a short one talking about the dot plot. Do you guys know what a dot plot is? Maybe this video might explain. What is a Fed Reserve dot plot?
Dot plot.
The dot plot. The dot plot is something that at times, I'm glad we have it, and at times it's more of a frustration.
Why has this one chart from the U.S. Central Bank become the de facto monetary policy forecast tool? Now imagine you're at one of the Federal Reserve's 8 yearly meetings. They catch up with their peers, listen to staff presentations, and decide what to do, if anything, about interest rates. But each quarter, the 7 governors of the Fed board and the presidents of the 12 regional banks update their individual forecasts for the current year and beyond. These include projections for the unemployment rate, inflation, all really important numbers. But what we're paying special attention to is the federal funds rate. Let's use the September 2024 dot plot as our starting point.
Now, each dot represents a policymaker's year-end forecast for the federal funds rate, aka the interest rate. At the September meeting, policymakers cut interest rates by 0.5 percentage point to a range of 4.75 to 5%. Zooming in on the 2024 year-end forecast, officials set their estimates between 4 to 5%.
Then they repeat this for the next several years. Plus, there's a bonus dot for what's called the longer run. Now, the Fed doesn't specify how long the longer run goes for, but it's where policymakers expect rates will settle. Eventually. Now you have the Fed dot plot. Question is, how do you read it? Here's my colleague, Reed Pickert, to explain more.
The dot plot tells us a lot about how individual policymakers are thinking about the economy. But because policymakers don't decide on one consensus forecast, it can be helpful to focus on the median dot, aka the dot that has equal dots above it and below it. Again, using the September 2024 dot plot as a guide, the median policymaker sees rates ending this year in a range of 4.25 to 4.5%. The median dot for 2025, however, is between 3.25 and 3.5%, a full percentage point lower. Investors would typically read that as a signal the Fed could likely lower interest rates 4 times next year. Now, to be clear, these are individual forecasts, not a decided upon path of policy. Policymakers can choose a different path at any time based on how the economy is evolving in real time, and they often do.
Thanks, Reed, but I gotta ask, if officials aren't even bound to this,
then why does it even matter? Because FOMC statements focus on current economic conditions and the interest rate target. The dot plot offers a look into the Fed's thinking beyond that.
The dot plot was introduced and adopted by the FOMC as a way to be transparent about the diversity of views. That's why it's individual dots.
And we love transparency. So does that necessarily mean that we love the dot plot and it's great and it's world peace and everything's wonderful, right? Not necessarily. Maybe some of the biggest issues some people have with the dot plot is that 1, it's not exactly a consensus forecast, but rather a jumble of individual projections. And 2, it's anonymous. So this dot could be Chair Jerome Powell, or it could be Susan Collins from the Boston Fed, or Atlanta's Raphael Bostic. And they could all have different ways of calculating their projections. The issues raise questions over how well the dots accurately reflect longer-term FOMC intentions. Even Fed chairs are a little meh on the dot plot. Often, they dismiss them as irrelevant or outdated.
One should not look to the dot plot, so to speak, as the primary way in which the committee wants to or is speaking about policy to the public.
For dot plot. Honestly, it's actually proven to be pretty good at doing its job, such as in June 2023, when policymakers refrained from hiking rates. But because the dot plot showed more increases to come, it did play a role in avoiding any bursts of investor exuberance over the tightening cycle being over. There's beauty in the duality of the dot plot. They love it, they hate it, it's cryptic yet crucial. But for better or worse, the dot plot remains a tool in the Fed's arsenal that hopefully you now know how to read.
Yeah, that wasn't that bad of a presentation. I don't know, very Gen Z, but I liked it. All right, Trope said, do people reverse engineering some winning options by using max pain data to calculate where it's going to go? That's the hard part. I don't think you can. Because we had this one, we had it right during the week. You had Powell. Powell could have said completely different things. I mean, and also it also depends on where people are positioned, right? Too. Going into it, so it's like earnings. If I could predict earnings moves, that's also like something else. I don't know. I think you got to have some insider trading on something, you just can't. Shoot, I don't think it's enough. Yeah, because you're not gonna. I don't think you could figure out which options are like held by the actual like insiders. You know, there are gonna be people in the group of gamblers that are insiders, and you can't tease them out from the morons that are just grouping up because of some reason. Because the market maker is not necessarily an insider. The market maker just wants things to go where they want it to go, you know, and it's not necessarily an evil thing, right? It's just that like when they sell you an option, they have to buy or sell a stock to compensate for that option, because they're selling you insurance, and they also have to get their own insurance, right? So that's just how it is. So it's just that like so many people are using options now that it's just become a big effect. Yeah. By avoiding the max pain point, but still riding the current towards it and getting out before getting burned. Yeah, I don't know, man. I don't know. I haven't found any clear way. I think it's a crapshoot. But at least you know about it. And to me, it's like I never play earnings, right? I always I will, but like I try to avoid. Most of the time when I'm trading between like the earnings dates of a stock. I just want to play the lead up into an earnings or after the earnings, and then the move out after that. And that's it. I'm not going to play to the event. If I know an event is coming, and if that event is coming right around where these options expirations are and it has a big effect like this one, yeah, I would just avoid it completely. I wouldn't even trade it. And that's why I was kind of pissed about that Bitcoin one, because the Bitcoin one was like a real easy one. The Bitcoin was already dropping from where it was like on Monday. Like the S&P 500 actually, I think, yeah, maybe the Nasdaq even went up again on Tuesday, or no, maybe not. I think the S&P might have. But I think, yeah, that was probably just because of futures. I don't know. I keep forgetting because there's a futures rollover or something. I don't even want to get into that. I just get confused again. But to me, like most of the moves done, why bother? I'm just being extra greedy, because obviously people would love like the kill shot, right? If you got the kill shot where like, let's say you were long before the FOMC, before Powell talked. If he talked real sweet, you know, it could have easily went the other way, where the market just shot up 3% that day, because there was so much gamma on there. And that's why I was playing Samantha LeDuc's video that during that time. It's like I show you like exactly like a lot of people were thinking like, well, there was a chance that the market could have just shot up like insane. And then once it shot up, it would have kept going into New Year's. But obviously that didn't happen. We went the other way instead. And now we're just going to go back up to that previous top we had on Monday. And that's it. That's the end of it. And that's probably it. We're going back down on the first week of January. That's my guess. You know, I don't think we're going to make a new high. So I think that scenario is out the window. Sorry. Because if he said other things, yeah, I would have said completely different things today. I would have been like, yes, perfect. Well, that means we have a whole quarter, a whole 3 months where we could just gamble and keep like just pumping in through like small caps and all that. No, that's over. Nope. Now it's just like, it's not going to be easy like that. Okay, so we're going to get Jeff Gunlock's opinion on this stuff. So he's a macro guy. He's the bond king. He loves doing that bond stuff. So this is very dry, but you know his analysis is always something you should listen to a bit, because he's very sobering. You know, you gotta be sober on a Friday night.
For more, let's welcome in Double Line Capital CEO and CIO and founder Jeffrey Gunlock. Welcome back on what's become a tradition, and I'm glad to have you, Jeffrey.
Good to be here, Scott.
Your reaction on what you just heard and what the Fed did?
Well, there's a lot more confusion now than there was a couple of months ago regarding the future path. but the squaring of the 2-year Treasury yield and the Fed funds rate is now complete. I talked several months ago about the Fed was behind the curve and needed to get aggressive in getting more in line with the 2-year Treasury. But now the 2-year Treasury is at 4.35, and the Fed funds rate is at 4 3/8 if you take the middle of the range. So they're exactly there. Underneath the surface, though, there were a couple of problems. The first thing he said at the beginning of his press conference, as always, is they're squarely focused on their dual mandate. And then he used the word cooling for the labor market, and he pointed out that it's looser than it was pre-pandemic. So that seems to be not trending quite the way that might want. And at the same time, he said uncertainty regarding inflation is clearly higher. In fact, I think he let something slip on an ad lib, and I think he said, let's see, he said the forecast from a few months ago on inflation seems to have fallen apart, I think are the words that he used. So what we have now is a neutral rate versus the 2-year Treasury, yet the dual mandate that they're squarely focused on is not exactly trending in the perfect direction. The inflation data points have not improved since the September meeting. We follow about 30 different inflation primary inputs, and the number that are showing accelerating inflation in the several quarters ahead have increased since September. Also, what's very interesting about what's happened over what's been really a very aggressive cutting cycle. I mean, they've cut 100 basis points in 3 months, so that's a 400 basis point annual rate. And if you go back over all these Fed hiking cycles or cutting cycles, Fed cutting cycles going back to 1984, so going back 40 years, this is the first time that after the first cut in the Fed funds rate that interest rates have gone up and not down. The 10-year Treasury yield is up by 80 basis points from September 18th, and usually the yield falls on the 10-year Treasury once you go into a Fed hiking cycle. So the takeaway that I got from that press conference was there's not going to be an aggressive cutting cycle as a base case in 2025. Obviously, the market went from 4 implied Fed rate cuts in 2025 to now the Fed's down at 2, and the market is pretty much in sync with that. So much slower rate cuts, and of course, risky assets and a very highly valued stock market doesn't like the idea that rate cuts are less likely on sort of both sides of the mandate. Are in tension with the path that was so comfortably in place per the press conferences in the mid part of this year. That's the confidence just isn't where it used to be. So I think the Fed is now extraordinarily data dependent as we enter 2025. I know they're always data dependent, but at this juncture, it's critical that we watch that unemployment rate, which Fed Powell said that job creation is not high enough to keep the unemployment rate steady. So the base case is that rate's going in the up, which is not the direction they want. And at the same time, some inflationary primary inputs are suggesting that we're not going to get to 2%. I thought the last question that was asked in the press conference was a perfect ending. Kind of, is it good enough to be at 2.5% inflation? Do we have to give up on 2% inflation? You know, is where we are the best we're going to get? And my takeaway from that press conference is the short answer to that is yes. I think that we're not likely to get to 2% inflation in 2025, and the Fed says so themselves. In fact, we'll probably start having inflationary pressures towards the middle of 2025, and the headline CPI rate will probably not be below 2.5% when the inflation rate starts heading up towards 3%. Now, obviously, all these things can change. We don't have great visibility on the second half of 2025. But unless the price of energy falls, which is possible with drill, drill, drill being the rhetoric of the incoming Trump administration, we'll see. But oil prices have been remarkably stable. And that's the real wild card is if they would go up for whatever reason, we would start to see significant inflation risk and there'd be no Fed cuts in 2025 if that's the case.
Do you believe the projection of 2 cuts next year? How many cuts do you actually think they'll be able to do if you think that inflation is going to be even stickier than they may think? And they clearly think, as Powell said himself, quote, we see the risks as higher. He called it, as I suggested out of the news conference, he called it the single most important thing that moved the needle today, the fact that their own inflation projections are higher than they were before.
Yeah, I think looking forward for 2025, I would say that 2 rate cuts would probably be I would say that's kind of on the maximum side right now, because I didn't hear anything really from that press conference that suggested that we're looking at rate cuts. I think you opened up by saying you might interpret what was said as there's a pause coming. I would say that that's absolutely the case. That I would say the odds of a cut in the January meeting are quite low at this point. And I think that speaks to the fact that they need a few months of data to try to figure out where their footing is right now relative to that dual mandate that they've been, every news conference starts out with, we're squarely focused on it, and they're not there. And it's moving in the wrong direction, I think, on both ends. So I would think that 2 rate cuts would be the maximum in 2025, surveying the landscape as best we can from here, middle of December of 2024.
Their estimates have obviously been off in terms of where they thought the neutral rate was. Chair Powell saying today, quote, "We are significantly closer to neutral now," obviously implying that they're close to being done because the neutral rate is much higher than they once thought it would be.
Yeah, I take a lot of incoming, unfriendly fire for my constant comment that the 2-year Treasury is really the guidepost for the Fed. But I deeply believe it, and I can prove it if anyone wants to spend 15 minutes going through some charts with me. It's been proven once again. They are basically neutral relative to the Treasury bond market pricing, the 2-year Treasury, and he acknowledged that the neutral rate is higher. So it's fascinating what's happened. I mean, they've gone from this massive gap between Treasury yields and the Fed funds rate, and now with the Fed funds rate being down by 100 basis points and the 2-year Treasury up by 80 basis points, that gap is completely closed. So I think it's not illogical to believe that 2 rate cuts is, if anything, on the high side as we survey, obviously, an uncertain landscape with a new administration coming in and the like. But I think 2 rate cuts is now sort of a maximum for the year, which is why we need to reprice some of the, the PE ratios and the stuff that have been hoping for more than a rate cut or 2 in 2025.
To what degree is the new Trump administration's agenda inflationary in its own right? They just don't know. Tax cuts,
that's right,
tariffs, stronger economic growth. It throws a real bit of uncertainty into their own calculus.
It does indeed. And I think Jay Powell tipped his hat to that concept. I think he used the analogy of a room full of furniture that you walk into and the lights aren't on. You got to watch out. You got to walk more slowly. You got to be careful and be feeling your way. So I think that's a beautiful analogy. I'm glad he used it because I feel like we're back at that place again that we were a little bit differently, but some of the same dynamics going on back almost 3 years ago when I used the Mr. Magoo sort of analogy, with the car that's bumping into the trees and stuff because you can't see very well. Well, Jay Powell just said they can't see very well right now. And that's acknowledging what you just said, Judge, and that is that who knows what's going to happen. It seems like Trump is angling for an inflationary-ish policy. Tariffs would raise inflation perhaps by several tenths, depending upon how they're applied, and we don't even know how that's going to happen yet. And what's going to be the stimulus to the economy? Is he really going to be expanding the deficit, which would be really dangerous, by having tax cuts? We already have a big problem. We have rising interest rates. They're already up on the long end by over 300 basis points over the past 3 years. And this is causing further pressure on the budget deficit, which I talk about all the time. But now that rates have gone up 80 basis points in a Fed cutting cycle, I think there's tremendous uncertainty on what's going to happen with inflation, the deficit, and the economy. And the base case is one that is not going to make Jay Powell's job any easier. Probably higher inflation through tariffs, at least initially. And the unemployment rate seems like it's heading higher per Jay Powell's own analysis. So it's a tough period now with assets as high as they are in terms of valuation. One thing that I think is interesting for investors now is it seems unlikely that you're going to get a big drop further in the Fed funds rate. And that means that we're back to attractive yields being somewhat sustainable, possibly, on things that are pretty safe and rates are high enough that they give, and their spreads that you can get a yield above inflation. So you go back to those BB bank loans, which were under pressure with the Fed cutting, but now that the Fed is much more likely to be on hold, those yields, they're pricing above a 4 3/8 sort of a base rate. You put a couple hundred basis points on there, and you're cruising along at about a 7% type of a yield without a lot of risk. And the chance of that yield dropping thanks to rate cuts is demonstrably lower today than it was, a month ago, say. So rates there are real rates. Jay Powell is correct about saying that. The inflation rate is sticky. He says it's now going sideways at about 2.5 to 2 3/4 year over year. But Treasury yields are up at 4.5. So there is a real rate there, and you can get real rates of return out of intermediate dated bonds if you take moderate credit risk, and it looks like that's going to be earned for some time to come. So I think that there's a good environment for that part of the asset class. Go ahead, Scott.
Forgive me for interrupting you, Jeffrey. You can't see it because you're looking straight into a camera, but you're looking at a market that is deteriorating as we have this conversation. We're down more than 800 points now on the Dow, near 2%, but it is the NASDAQ, Jeffrey, down more than 3%. That's a loss of more than 640 points. If you look at the Treasury market, obviously yields, as I suggested at the outset here, are higher. You're at 450, Jeffrey, on the 10-year. You're at 435 on the 2-year. We've seen the dollar spike as well, which is going to be very unsettling to some, certainly multinationals, when it comes time for earnings. How should we think about all that?
Well, we've had such a powerful run in risk assets since the Fed started cutting rates. We had about a 10% gain in, say, the S&P 500. We had a loss of nearly 10% on 30-year Treasuries. So it's a very unusual situation that the valuation has gotten that out of whack during a Fed rate cutting cycle. So, yeah, the market is clearly overbought. The PE ratio, the CAPE ratio is up at 38. I mean, these are high valuations, and there's a lot of overbelief in the market because it's been so good. And unfortunately, human nature is to project forward what's happened in the recent past, and particularly when it goes on for more than a few months. And so there's a lot of overinvestment that, there's a lot of profits to be taken. Let's just put it that way. And so it's not surprising that everyone expected the so-called, it's kind of an oxymoron, but the hawkish cut. But I don't think they expected so much uncertainty to come out from that press conference on pretty much all sides of the future outlook. And what you're saying is there's a lot of uncertainty, and who knows what the economy might have to experience. I think that all kind of explains that there should be some sort of at least a short-term repricing. You never know. Fed day can be a head fake. You never know.
Sure.
We have to see how the rest of the week evolves, but I wouldn't be surprised if we saw lower prices in the aftermath of this Fed commentary. It certainly is justified.
940, the loss now on the Dow. You said ahead of the election, Jeffrey, quote, if the House goes to Republicans, there's going to be a lot of debt, there's going to be higher interest rates at the long end, and it'll be interesting to see how the Fed reacts to that. We sort of alluded to this already, but I want you to go deeper on that because we obviously had the red wave in the election, and now we're trying to figure out where we're going to go from here and how the Fed is going to react to it. You wrote a guest essay in The Economist recently as well, where you talk once again about your worry about the ever-growing deficit. They, being the administration incoming, think that they can grow their way out of this problem. Do you disagree with that?
I think it's hard to grow your way out of the problem if you're doing nominal GDP that's really strong, because nominal GDP being really strong would mean higher long-term interest rates. And my thesis that we are in secularly rising interest rates now at the long end seems to be being borne out. I mean, here the Fed has cut rates 100 basis points, and the 10-year Treasury yield is up by over 80 basis points since that time period. So I think that you have a risk that the interest expense on the debt is going to be really problematic in that nominal growth scenario. Because if you get so much debt that is leading to this nominal growth, you're going to have not just more bonds, you're going to have a higher interest rate on those bonds. And this is not hypothetical. It's happening in real time. The Fed has cut rates 100 basis points, and the 10-year is up 80 basis points over that time period. I think that has something to do with the market sussing out the fact that we have an interest expense problem. We used to pay $300 billion a year in interest expense, and now it's $1.3 trillion a year in interest expense. And we still have all of these bonds that were issued in 2017, 18, 19, first part of 20, down at 1% interest rates. They're being rolled over now at 4.5%. And so it doesn't look like we're going to get a lot of relief out of that 4.5%, because that's where the short rate is and that's where the long rate is. And so we're going to continue with this interest expense problem. So I have a hard time believing that you can do this magic trick of high nominal GDP and low inflation and low interest expense. The arithmetic just doesn't add up. And that's kind of the point that's being made, that we've talked about interest expense problems for 4 decades, or 3 decades anyway, since Ross Perot did the voodoo stick on his infomercials. And of course, what I always say in the investment business and in macroeconomy, things can happen as you expect, but will always take much longer than you think is humanly possible. So here it is 30 years later, 32 years later than Ross Perot, and he was right about a debt interest expense problem. He was just at least 30 years too early. It takes longer than you think, but I think the worm has turned here, and I don't think you can have a nominal growth solution. You need to have some sort of action taken on this expense issue, and I hope that this DOGE, I don't know what you call it. It's a group of people, I suppose. It's not a cabinet position or anything, but the Department of Governmental Efficiency, so-called. I know they're not going to take a huge chainsaw to expenses, but hopefully this is a step in the right direction. At least we can start. I know you're not going to find hundreds of billions just laying there on the sidewalks that can be comfortably cut, but at least let's move in that direction. Let's start with not promoting Egyptian tourism with $6 million of borrowed money from the U.S. taxpayer. Let's start there and then move more aggressively as we find our way.
Down more than 1,100 now on the Dow, so we're falling apart a little bit as the market tries to come to grips with what Chair Powell had to say, even as the market was pretty much set up for fewer cuts already, the Fed moving towards it. But I think the market trying to suss out, Jeffrey, what all of this means for the coming year and whether we'll actually get the cuts that the Fed is even projecting now, whether inflation remains even more sticky than it fears. You told me last time that you liked the intermediate part of the bond market, of the Treasury curve, the so-called belly. What about now?
Yeah. Well, I still like it, and it's not so much that I like the belly, it's that I don't like the long end. And you have to be somewhere. And so I don't want to own 30-year Treasury bonds. I don't want to own even anything longer than 10-year Treasury bonds. There's no extra yield there for it. I mean, you're only getting 14 basis points going from 2 years to 10 years. So I think you hang out in lower duration than an index fund, and you have a middle of the capital structure type of a portfolio. This is what we've been doing pretty much all year, Scott. We've lowered our interest rate risk systematically, not in a large way, but systematically over the course of this year. And I think you can get yields that are in the 6% to 7% range without a lot of risk out of fixed income. But you want to do that not in long maturities. You want to do that in a portfolio that's sort of 2 to 5 to 7 years at the most, so laddered out that way. And I think you've had a pretty good year. There's plenty of fixed income types of products of this ilk that I'm describing that are up over 8% total return year to date, which is very substantially higher than an index fund. And I still think that that's the playbook as we turn the year, although I do note that it's very interesting how often the market changes direction right at year end as people reposition for the new year. I wonder if we won't see interest rates start the year with a rise to the upside again, as we did entering 2024, especially at the long end.
Well, I mean, it's the most difficult thing to to project. Here we are at the end of the year, as you say. No one wants to sell a lot of things, although they are obviously today. You have tax considerations to make, but when you turn a calendar into a new year, there could obviously be some selling related to that. Let me ask you about Bitcoin, because we haven't talked about that in a while, and you've watched it like we all have. Country seems captivated by this move that we've seen since the election. What are your thoughts?
Yeah, I think of Bitcoin as owning gold on substantial leverage, maybe even as much as 20x leverage. And gold has moved up a lot, and Bitcoin obviously has moved up a lot more, particularly in the aftermath of the election. I believe that both gold and Bitcoin have been, their strength has been a harbinger of skepticism regarding the fiscal path that developed countries are on. And I think that has probably been relaxed a little bit today, perhaps, but I think that the positioning in gold and Bitcoin will probably continue to increase. I view that people are viewing them as more asset allocations than speculations as we look into an uncertain future regarding the economy, the Fed, the pace of inflation, unemployment, all of this stuff, and the need for fiscal rectitude starting to become more clearly in focus, which I think will happen. So I continue to hold gold. It's quite high. It's not going to like this rise in the dollar. It's not going to like the fact that the Fed is less likely to cut rates. So in the short term, I think we'll probably see sideways movements in both Bitcoin and gold.
Do you own any Bitcoin at the current time?
No, I've never owned Bitcoin. It's just not for me. I just can't stand investments that are that unanalyzable and that illiquid and that high risk, high volatility. It's really the volatility that I'm allergic to in Bitcoin. So I don't think I'll ever own Bitcoin until such time as we have a total regime change and we would actually have a cryptocurrency. A cryptocurrency or a digital dollar, if you will. I think we're ways away from that. But if we ever get there, then it's going to be sort of forced to play by the rules of the game.
I always like to get your thoughts as well. Let's do this lastly on what the best looking portfolio should be right now. You have not, often suggested 60-40. You've suggested the breakdown should be smaller in different areas. So given we've had in stocks, where you think we're going in terms of yields, what you said about the dollar and gold and Bitcoin, what do you think the right portfolio breakdown looks like right now?
I think now you should be increasing cash because the yield on cash appears not to be going away. So it looked like there was a chance, that we would have a shrinkage in the cash yield, but that's not likely to happen based upon today's press conference. I would actually hold about 30% in cash right now because you're not giving up much yield versus other assets that have volatility and risk. I like that bond portfolio that I described, obviously, because that's how I'm managing my money and my clients' money, and I would have half of my money in that and about 30% in cash, waiting for the volatility to give you better entry points into riskier assets, and then 20% I would own in basically, and then 20% I would own in basically at this point I would own U.S. stocks at this point. It's not a very high allocation, but I think that U.S. stocks continues to be supported by the strong dollar, which should maintain for some time now that the interest rate differential is likely to stay in the dollar's favor as we move into 2025.
Jeffrey, we're going to leave it there. I so much appreciate this past year visiting with you every Fed day. I know our viewers do. I certainly feel smarter after talking to you after one of these decisions and that news conference, and I look forward to a new year of doing this. Happy and healthy 25 to you.
Same to you, Judge, and good luck, everybody. Happy, healthy holidays, and let's have a great 2025.
All right, there you go.
All right, have a happy new year, guys. Have a happy new year as well. Let me go over some cleanup work here. Okay, so one thing I have to mention before I forget, I'll have to mention this again some other time. But first, I'm going to go over the altcoin situation here. So now we've dropped below 47 on the altcoin season index. So, yep, not looking good. Not looking good for now. Bitcoin is still struggling. So we're going to have to see how the new year goes. If any of these altcoins are going to make any serious move. But it might be over. So this might be it. Because if we get a strong reaction to something later in January in the markets, I think this is going to pull everything down again. So don't hold your breath. You might have to wait for March to try this again. Okay. It's not going to be easy 2025. It seems like it. So maybe February to March might be a better time. Don't expect any fireworks in January for that. The other thing to talk about is I made a mistake on one of the tickers. So I said a UNG was gasoline. No, that is natural gas. That's why I kept looking at that chart. I was like, that looks so familiar to Boyle. So yes, it is similar to Boyle. So that's the natural gas ETF. So it's been doing quite well just based on the chart. Okay. So this is the natural gas ETF UNG. And that tracks the Henry Hub. Let's see, Henry Hub futures. So that tracks the Henry Hub futures. And Boyle is a more leveraged one. So that Boyle is what I tend to use. But yeah, it's not UNG. So Gasolina is not UNG. Gasolina is UGA, is Gasolina. And we're not there yet. Okay, so gasoline. And that follows the RBOB futures. So no movement on the gasoline yet. So I'll have to update you guys on that. But natural gas so far has done quite well. And maybe it's just because Trump is now talking more about, oh, you're going to get tariffs, Europe, if you don't take more of our liquefied natural gas. But I think the weather is really confusing a lot of people. People don't know if it's going to be a mild winter or not really for the January month, January to February. So right now it's just we just have to have forecasts for January, mid-January into February to complete the whole picture of how much natural gas is going to get consumed, okay, before rebuilding into the summer months. But I think I'm pretty damn bullish on natural gas next year. So this might just be the start, okay, guys? So I was already bullish this year, but it never crossed over like 3 million BTUs, British thermal units, $3 per million BTUs. So this thing we have to watch carefully. So next time I show up, let's see what happens next week into Christmas. If I see something interesting, yeah, I'll present something with natural gas. But natural gas companies also have done quite well this year. In some of them, I've shown some tickers of them into Trump's election. So just even before Trump's election, these stocks have done quite well. They're still hanging out up at the top. So waiting for some kind of dip. But I don't think that's happening. A lot of oil companies, though, a lot of crude oil-based companies have been in trouble. So I think they're scrolling down right there. I see EE, WMB, EQT, and ET. Those are 4 natural gas companies that I saw charts that look really nice. So we'll go over them later. So maybe in springtime, closer to spring, we can start talking more about that. But if I see something more explosive happening in the Christmas into New Year's with natural gas, maybe it's different this time, because usually winter months there'll be a dip. Maybe this dip is more of a sideways action. That's very bullish. Okay, I'll see you guys later. Have a good Friday night.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel feel like I should 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 feel like should feel like should feel like I should. Feel like I should